Oh, Michael, don't on Zoom, don't actually mute yourself because it's not going to record there. Yeah, so we just missed all that, but
No?
don't worry about it. I
Okay.
just noticed it now.
All right, my bad.
So no, it's all good.
Yeah.
Um,
So again, one rental at a time, houses, small apartments, portfolios, almost 200 units, started in '02 to 2020. The good news there is I invested through the last run up,
mhm.
and then the crash, and then this newest run up. And it's kind of an interesting story because there were two hot entities that made up the '08 crash and then what I'll call late 2019.
Mhm.
And I'm on record of exiting both of those near the peak, which allowed me both times to either leverage equity or, in this case, leverage cash so
Mhm.
that I could take advantage of what is coming. So definitely buy
Gotcha.
and hold, landlord. One market, I live in the Bay Area, but I invest in Fresno, California.
Mhm.
And that's where I've been. I haven't, I've looked occasionally out of state, but there was no reason to. And now, my rentals pay for our daily expenses. We don't live flashy,
Mhm.
but the wife's been retired 5 years. I've been retired over two, and now I spend a lot of time talking about one rental at a time being an okay thing. And you know what? If most people just had a goal of getting to 4 rental properties, that would be pretty good for most people.
Mhm. No, I agree. I love your story. I'm a big fan. I think you know that. So I hope you
Thanks.
keep on doing it for a long, long time. I do want to get into kind of what you alluded to with exiting and also what you've seen going forward and what you've seen in parallels to, the 2008 crisis and to here. First, though, let's start on the here and now.
Yeah.
It is April 11th for anybody watching as the recording. What's it been like the past several weeks for you? What's it at today for all your rental properties and things like
hmm
that?
Yeah. So we started taking action March 15th.
Okay,
Again, let's say we have 200 units just for easy math.
sure.
Again, we don't manage any of our units, so we have property managers there. So on March
Mhm.
15th, I sat down with the owner of the company and my direct client manager and said, okay, let's go through all the units. Let's look at what we have, right? Because again, for 2 years, the checks, the cash flow, the positive cash flow has been coming up in significantly more than I needed, so I wasn't really managing it all that close, right?
Mhm.
But I was afraid. I was afraid for April 1st. I'm like, I'm hearing all these dire warnings and just not sure what's going to happen. So what we did is we sat down and realized about 35% of our income was Section 8, backed by the federal government. Done, right? Money's coming in, came in
Yep.
early. Um, Another 15% or so were other housing assistance, which we felt good about at least for the next 6 months. So
Mhm.
about half our income we felt good about. Then what we realized is the next 30% or so we felt relatively good about. They, based on where they worked, they were either classified as essential or there was enough income there where one of the adults could lose their job and they could still, at least we thought, comfortably make rent. So that
Interesting.
left about 20%. They were like, ooh, the main breadwinner loses their income, or we knew they were in hospitality or something. We're like, ouch. So
Mhm.
we actively reached out to our top 25 at-risk tenants in March.
Mhm.
I think all were contacted about the 20th or 21st. We let them all know if they were directly impacted by this. We wanted to work with them early. We were willing to do payment plans right up front. So we identified the high risk and we attacked it. Only
Mhm.
4 or 5 took us up on that. But it was nice to touch base with the high risk candidates, right?
Yes.
Now that we're into day 10, day 11, we've collected almost 90% of our rents. Most of the missing payments are from our high risk, so we got that right.
Mhm.
Um, so typically my portfolio we would be 97% collected by the 15th. So we still have a few more days. This is a long weekend, so we shall see. But right now, knock on wood, April is better than expected.
That's awesome to hear, and I love the level of detail. I think it's amazing how quickly you responded because I'm just pulling up a calendar, and the reason I did that is because I'm trying to keep track of like when we started doing things in our head because things are changing so day to day and week to week. Where now it's like it's a very real thing, but there was a point in time where nobody was even talking about it early March, or very few people. And it was
Mhm.
just something overseas and whatever. And then even around that time, it was, it's not that big a deal or whatever. It's whatever. And I'm looking, and like 15th was a Sunday. The 16th was a Monday. That's the day we came in our office and we all sat down and we were like, hey guys, this is being in New York. We were like, hey, this is no joke. We got to work from home. So it's
Yeah.
very interesting to hear from you as well. Very similar time frame. It was like, guys, this isn't a joke anymore.
Yeah.
We gotta flip the switch. It definitely took us a little bit longer than you to sit down and really examine that tenant base. And I'm curious, was there anything in particular about it that you looked at and said, we've got to do this now for April? Like, what was it? Because even still, it sounds like you reacted quicker than us and you were
Mm.
quicker off the foot. Was there something you saw? Was there something that really
Well,
brought to your attention that you were like, hey, we need to take this thing seriously now?
yeah. Well, again, my experience. So we had about 80 units in 2008, 9.
Mhm.
And some of my worst collection months as a landlord were 2008 and 2009. We're talking about something in the 70s.
Mhm.
So um, we had a lot more debt in 08, 09. So at
Okay.
70%, that was painful. We actually reached in our pocket a couple of months over those 2 years to,
Hmm.
add to the mortgage payments, which were only, I think we've done that twice in the last 10 years or so, but that was why, right? I remember those times. And oh, by the way, back then, the wife and I both had 6-figure jobs. So it was easy to do, right?
Sure.
We've been out of work a combined 7 years now and have no
Hmm.
interest in going back. So we're like, man, could 70% happen again?
Hmm.
Our debt structure is way different now, so it would probably have to be in the 60s to be a problem. But still, that was fresh. That was enough of a wound to go, oh my God, if the world falls apart and everybody goes on rent strike,
Hmm.
maybe, right?
Hmm.
Maybe we have a problem. And that experience, that scar that I could look for on my arm and go, ooh, that hurt. That's what made us act fast. That's what made me call our property manager and say, we got to talk on Sunday. I don't want to wait. I don't want you to go to the office on Monday and do this. I want to do this on a weekend so that we can have a discussion and just be us, right? Because I've known the guy for 10 years.
Hmm.
And I didn't want, office noise to get in the way. I wanted to have direct conversation. And then we got our point of contact on the phone too, which was, I was gracious to have. So yeah, it was just experience, I guess.
Sure. And was there at any point over the last 10 years that you had the similar feeling and it didn't pan out? Or was this like, you know, just something
No.
about this just really struck differently and you're like, this is, like, I'm very certain this is going to be it. This is going to be a problem, stuff like that.
Yeah, yeah, this is the only other time, because really what happens in the landlord game, especially where we play, right, the affordable housing market, all you have to do is track consumer behavior,
Hmm.
right? It's all about the consumer. Is the consumer happy or afraid? And we went from, January, February, where the consumer was giddy, to probably as scared as I've ever seen them. They were probably as scared in 9/11, but 9/11 was a very short 10-day, 15-day period. And we only had, I don't even think we had a rental at that point. But people became afraid and it became quick. So I watched that, right? When the consumer is afraid,
Hmm.
landlords should watch out. Now, I believe landlords need to watch out in Class A more than Class C, because all of the help that's coming, most of my tenants are going to make more on unemployment than they will being
Hmm.
employed,
Yeah.
at least for the next 4 months. But yeah, I believe we will come out different on the other side of this. I
Hmm.
actually think we'll be more of a landlord nation, because I think more people will just realize, I don't want to own anything.
Hmm.
Um, so I think being a landlord is going to be a good business, even more of a good business going forward. So yeah.
It's very interesting to hear you say that. Yeah, I was actually talking with an investor and he was asking the question of, what do we see happening? And he said, you should really try to find out how people reacted after 2000, after 9/11 and
Mhm.
kind of compare and contrast. And I thought that was interesting. So, I'm curious to hear that, but what were you looking at to kind of gauge consumer reaction? Was it the stock market? Was it just the news? Was it people in your
No,
town? How was that?
it was just basically shopping, people at restaurants. That's where the consumers are for me. Most of my tenants don't have stock portfolios.
Hmm.
So what happens in the stock market? I mean, I doubt even most of them know, right? They may know in passing, but Amazon goes up or down, Zoom goes up or down. It means nothing to their daily
Yep.
lives. So there is there is no interest. What I'm watching for is, hey, are people going to restaurants? Are people going to the mall? Are they buying coffee? Are they getting gas? Are they just going to the grocery store? When you see downtown empty, that's a problem, right? That means the consumers are scared.
So you were seeing downtown empty around that 15th date?
Yeah,
Interesting.
well, they're not necessarily empty, but changed dramatically so, right?
Gotcha.
Right.
Yeah, because I know it's funny, we joked and it ended up being the case. My roommate and his brother, we actually went for dinner. I don't know if it was the 13th or it was a Friday. I don't know if it was the 13th or the 6th. But as it was starting to kick up when we started joking around at dinner, calling it the last dinner. We might have had a few drinks that hopefully emphasized that. But then it was literally like, the next week I stayed home in Brooklyn. And then
Yeah.
the following week, my roommate was still going to work. And then he said, "Hey, I'm starting to work from home." I was like, "I got to get out of here. Like, this is going to be cooped up. And I'm all the way out east now. But I've heard it's a ghost town." So like, I don't think I experienced that, as I'm thinking just of myself, of like, I didn't
Mhm.
see a dramatic drop off then, but definitely by the following week, I started seeing things like walking around the end of that week. It was like when a lot of retail shops were closed. It was just like less and less people out walking around. The grocery stores were still very busy, but it wasn't. I didn't get like the mad dash for like toilet paper and stuff by me. I didn't see it. I don't know if that's just because it was the city or they just did a better job. Who knows? Um, but yeah, definitely, I think that's interesting, and it's something I've always got to remember because you know being in the investment space and stuff like that, you tend to look at the world differently than I think the average person. So I think that's good
Yes,
to keep in mind that like you know they probably
yeah.
didn't even know the stock market went down 30% in 3 weeks or whatever it was.
Yeah, the fact that the stock market had, what was it, 9 days in a row where it was up or down 1,000 points means
Hmm.
absolutely nothing to my tenants, but it does mean something to the lending world, right?
Yes.
It does mean stuff to the buying world. So it depends
Hmm.
where you're playing, because if you're going to be a private lender or you're a somebody going to get a bank loan or something, that makes a difference, right? Because where's your down payment coming? If you're an owner occupant buyer, where's that coming from? Are you scared? So stock market certainly is important to track, and I track it every day, but it's not for my tenants. And I think that was your initial question. Yeah, the tenants is just, hey, are people out shopping? Do you see bags in their hand? And what we were watching is, again, the wife and I are retired. We would go out to lunch every day in downtown Mountain View, which is the city we live in, and you could see it change almost every day, right? Where it
Hmm.
would be packed. It was like packed on the 9th, and by the 15th we're showing up at 12:30, which is like peak time, and there's like 3 tables. We're like, ooh, something's different, right? Something's
Hmm.
going on. So
Yeah, I should have realized it the last week, and now looking back at it, I didn't. I guess I knew it was a takeaway, but I didn't really like pin it as like, okay, this isn't good for everybody. I just thought it was like a weird quirk that was going to go away. Our office is in Long Island, so I do the reverse commute from the city to Long Island. Most people do the
mm,
other way. But if I leave at 7:30, 8 a.m., whatever, there's still traffic. Like it'll back up and stuff, and I can see the traffic going the other way. That whole week, so from the March 9th to March 13th, no traffic. I'm talking
yeah,
there was people driving, but very little traffic. And I was like, this is fantastic. This is amazing. And I'm thinking, oh, I hope this keeps going. And then obviously it got worse to a point where we're like, hey, we need to stay home.
yeah,
But yeah, to your point, it's just, I could sense that there was less people on the road, and it wasn't something I put my finger on at the time. But now as we're talking, this is good for me, at least at the
yeah.
very least to, I should have recognized at the moment is like, hey, this can lead to bigger problems. So that's really interesting to hear. Um,
Well,
you touched a little bit on, you said before the last crisis and this one, you were fortunate enough to sell off at the top. Does that mean you have been selling off the past 6, 12, 18, 24 months?
Yeah, the last 12 months or so, I have sold off 50 units in apartments, 3 different buildings,
Mm-hmm.
right? I think it's a 13 and 18 and so maybe it's 48 units, whatever that is. 13 and 2 18s, whatever that is.
Roughly 50.
49.
That's fine.
Yeah. And yeah, we sold them off, and we took the cash. Yeah,
Mm-hmm.
we had carryover losses and whatnot from depreciation because I was a high income earner, so I couldn't take it. I wasn't a real estate professional by the tax code.
Mm-hmm.
So we are paying some taxes this year, some capital gains for sure. But I'm really glad to have a lot of cash right now because, it'll be a tremendous buying opportunity going forward. And again, I talk with folks like you, and I go to real estate meetups, and I like to talk around the country because what I get a feel from is what is the audience excited about?
Yeah.
It's the same thing I did in '08. What's the audience excited about? And from 2018, everybody, or seemingly everybody, was on the bigger is better mindset, right?
Mm-hmm.
I'm going to follow Grant Cardone. Grant Cardone says, don't buy anything less than 16 units. If you do, you're an idiot, blah, blah, blah. I heard that over, it just built like a tidal wave.
Yeah.
And it got to a point where people were doing, 4.5 cap for my C-class properties in Fresno, which I wouldn't touch it less than a 9 cap.
Mm-hmm.
And I'm like, well, if you guys want to overpay that much, take them. And a lot of people called me stupid. I mean, I'm on record, like 6 months ago talking about when I sold my last building, and people were, in the comments going, what are you doing? You should be buying, you shouldn't be selling. I'm like, well, I've been here before, it's not worth it. And I didn't know this was coming. I had no idea. I just knew the prices were higher than I would pay by a lot, which is the same thing that happened in '08. I mean, you could look up this property on Zillow. I bought a property at 1818, so 1818 Norris Drive East, 93703. You can look it up on Zillow. I bought it for 107. I sold it 3.5 years later for 268. I took all of that equity, moved it into an apartment building, which I still own today. But the point of this story is that building I sold at 268, it went all the way to 300. So you could say I sold early. I lost 10%. Yes. But it rolls over. It doesn't retrade again till 75 grand. Right? And oh, by the way, sold here in the last 2 years for 180. So
interesting.
Yeah, I sold early, but oh, by the way, it's not back to 260, and I had 12 years in my apartment building, so whatever.
So you were saying that was a deal you bought prior to '08 for 100, roughly 100, sold for roughly 260, mm-hmm. and then it came all the way down, sold for 75, and then resold again for 180?
Mm-hmm. Correct. Sold for 75 at the depth of the crash, like 210, like mm-hmm. 2010. I think it traded mm-hmm. again in 2018 for 180-ish.
Yeah. No, I think I saw that a lot. It was always very interesting to me. I've only been doing this 3.5 years, and I'm always very upfront about that. I'm always very cognizant about what I do and don't talk about, not just because of it's, I haven't been through a downturn, but 3.5 years is not that long of a time to be doing anything. Mm-hmm. But I do because I know I have a certain level of knowledge that other people don't, that I can help share. Sure. But whenever I would look at properties, I would always look around what happened during the crisis. And awesome. The amount of properties I would see that sold for so much less than what they sold for right before. And oftentimes, like, you would have, 2 or 3 sales leading up to the '08 crash, and it would be lower than a few of those. I was like, that's crazy. I was like, how does that even happen? And then you would see it tick back up again. And I've always got nervous when the building was selling more than it was in 2008. But I knew that I never felt that there was necessarily a direct correlation, because I think, in my opinion, just the world has changed so much from then, is the sense I get, even just from a technology standpoint. So you never quite understood what it was. And a lot of the markets we were into, like perfect examples, Jacksonville, Florida, did not have the same job diversity it did in 2008 as it does today. Mm-hmm. So we got smoked in 2008. Like, I'm telling, like, it got smoked. Same thing with Atlanta, which is another one I know. And this is from what I've heard and been told and seen, they did a much better job of shifting it out. And I know like now, I think no like one sector or something has more than like 20% or like 18% of the jobs, which is phenomenal, which has been great because like you, we identified, I think roughly like 18% in Florida were like at risk, give or take. And I think it was a little bit higher up in Ohio, which is like our two main areas of holding. So those are really the only two we talk about. So it was interesting to see that from that standpoint. We also felt like, most of our properties we can underwrite to a high 60s to mid 70s break even point on occupancy, which it could be a reflection obviously of expenses or, not paying and stuff. People get too hung up on when I say break even occupancy. They say, well, what happens if your expenses go up?
Yeah.
6 and one, half a dozen the other. Exactly. It doesn't really matter. So we always felt pretty comfortable from that standpoint. So, that was always interesting to see. What do you think going forward? Because obviously nobody knows, right? And right now there is 1,000,001 opinions of what's going to happen in the future. Today, no question about it, valuations have been slashed. Just from the standpoint of the risk, the debt world, and the amount of capital currently at play. So if you were to sell today, you're way less than what you were 6 months ago. No question about it. Nobody can argue that whatsoever. I think anybody, unless you were in contract, maybe that's the only thing. But beyond that, and I know no crystal ball, but how does this compare to what you saw during the last crisis and how long that took for valuations to come back? And do you think we're better insulated, not as insulated? Is it different because this isn't a direct economic impact? It was a health impact and a lot of jobs just got halted. I'm just curious what your take is on all that.
Yeah. So I'm pretty big on the fact of there's two news cycles going on today that I want to dispel my opinion. First, 2020 is not 2008, period. 2020 was essentially the federal government taking our service-based economy and saying, stay home. So we are going to have record drops in GDP, probably more than 30%, probably more than 35%. But for the most part, that is self-induced.
Right.
That unfortunately has ripples effects. That means a lot of small businesses are going to go poof. Probably to the tune of greater than 30, probably 50%. However, that said, the American economy, the entrepreneur spirit, that just means there's opportunities for new businesses to be generated. I feel bad. It's going to suck. Whatever. 2008 through 2010 was a long, painful loop that just fed back on itself. My neighbor sold, so I got to sell, so I got to sell, so I got to sell. And it was painful to watch. I've been watching my market every day for nearly 20 years. And 08 to 2010 was painful to watch. It will not be, 2020 will not be 2008 for lots of different reasons. First off, banks are already talking about forbearance with owner occupants, where in 2008, they didn't do any of that for the first 9 months. And then they had the galls to say is we're not talking to anybody until you've missed 3 payments. How stupid is that, right? This was the idiocy of 2008 to 2009 is banks were not behaving well and they got smoked because if you're not going to talk to me for 3 months, great, I won't pay for 3 months, right? That was the attitude. Strategic defaults was a word, all of those things. So we may have some foreclosures coming, but that will be in 2021. But I do think banks are going to work with owners a lot more. The second thing is we will have a bounce where we may have a record decline of, say, 35% in GDP in Q2. Q3, God willing, will be a record bounce. It won't take us back to even, but it'll be 15, 20% as we get this economy going again, right? This will ultimately take off when there's a vaccine or treatments that are 95% and all that stuff. But this is not 2008 all over again. So I don't think we are going to have the same kind of valuations collapse. Like I talked in my market from 300 at the peak to 75. If you've been waiting for single family anyway to go on sale 60%, it's not going to happen. You may have a couple of markets like New York. New York could be in trouble, right? There could be a mass exodus. People could realize that living in a dense population, and I say this owning a place in New York. That's where my daughter lives. So this could be pain I feel very quickly. But most of the country, maybe 3, 4, 5% drop, maybe. But yeah, it's not going to be like that. Multifamily, let's go there now. Again, most tenants live paycheck to paycheck. As long as the federal government continues to help with souped up unemployment, that $1,200 shows up. I'm on record saying they'll probably do that again, meaning another $1,200 sometime, whether it's May or maybe it's June, because again, the government has said stay home, so the government needs to pay. And as long as we can keep the populace fed and sheltered, we're going to get through this just fine. Yeah. Valuations are going to be down. You may not see valuations like if you take peak valuation in January for an apartment, you probably won't get to that valuation again for 8 to 10 years. And that's going to be a fair amount of rent growth, right? Because cap rates just popped, right? Risk capital just popped, right? You're going to see cap rates like in Fresno. I'm sure I sold my last one at 4.5. I bet you it's a 9 or 11 here pretty soon, which obviously, directly impacts the value.
Yeah. So I agree with you on a lot of things. I think especially the recovery. At first, I thought it was going to be more of a V, where it was going to be, one down, one up, whatever that one is. If it's 2 months, 3 months, it'll be proportionate. Now I'm starting to think it'll be down more U, where it's down for a little bit and then comes back up. However, I do think that the first 3 quarters of it will be up equally as it is down. I think that last kind of tail end is very similar to what you were saying, that, where, the last 10% of GDP or the last few percentage points of unemployment, I think is going to take longer, whether that's end of 2021, mid of 2020, end of 2020, middle of 2021. Don't really know. It really depends on when they loosen this back up, when the vaccine becomes available, stuff like that. I'm a little unsure why you think cap rates have gone or will go so far the other way. Yeah. And the reason I asked that question is because my opinion is I do think it'll get hit. I just don't think it'll get hit that hard. And I think it's largely going to depend on what the debt is like when we come out of this. Because we saw, at least from us, 12 months ago, debt in the commercial space or in my space was roughly 4.25, maybe 4.5. 3-4 months ago plummeted as treasuries went down to low 3s. And all you saw was cap rates just tank with it. And that's why you were getting the 4.5s. So for me, it's if capital out there was willing to pay, let's call it 100 bips spread over cap rates or over debt. If I don't see us coming out of it and debt exploding to 6-7%, because treasuries aren't going to bounce, right? Treasuries are going to take the longest to come back up. They're going to be very hesitant to do interest rate hikes.
Agreed.
And if you can borrow debt in the 4 range now, once we come out of this and financials stabilize, let's call it end of the year, early next year, I think potentially, this year, I think, financials will probably stabilize. I personally, there's going to be a ton of capital that's just going to be like, this is 2008, everyone can buy whatever, maybe it was a 4.5 cap. Now we can buy a 5.25 cap or something like that. So I don't know if I see it that crazy. I'm curious to think why you see that way.
Well, so again, I've seen this movie before and now realize I have experience in one market.
Yep.
Right? I got 20 years experience, which sounds great, but I have history in a market with 1 million people, right? So on the scale of the US, it's nothing. But this is what I've seen in the commercial space is you may see what you're talking about in A-class assets, right? The best quality, the best areas, the prime markets may go to, if they were 4.5, they might go to 5.5 or 6. There's certainly going to be some premium short term, but what you have seen most recently, i.e. February of 20, is the Class C's were being treated like Class B's and Class B's were being treated like Class A's, and that cap rate compression where everything just got pulled to that 4.5. So again, in my market, it's probably a natural 7.5 if you blend the average of 20 years, but it got all the way down to 4.5 here in the last cycle. So it's
Right.
going to naturally snap back because it's a non-prime market. It's
Mm-hmm.
non-class A. And I believe it will naturally, at least short term, go above the median, which is 7.5.
Mm-hmm.
Will it go to 11? Maybe not, but it'll go to 9. It just has to. I mean, people get afraid and greedy at different points. Lending will be different. Again, commercial lending in Class A stuff is great. You'll probably get it for 35% down, right? And get 65% loan. I'm a second tier market. They'll go to 60%. I got to bring an extra 40, an extra 5% down. It's just, it's a non, tier one market, and cap rates are going to go up, and they'll double. They'll go from 4.5 to 9 for sure.
That's interesting. I still don't know if I see that. I think where we will get hurt is if the principal and interest carry continues. So obviously right now, for anyone watching commercial loan, under $6 million, Fannie, I believe Fannie and Freddie, you need 18 months of principal and interest day one as equity for reserve, which is a huge increase. That's like a 15% increase on equity, or you might even be purchase price. I did the math, I forget. If you're over 6 million and your debt service coverage ratio is between, I think, a 1.25 and a 1.4, don't quote me on this. Everyone go look it up. I think you need like 12 months. I think if your debt service coverage ratio is over a 1.4 or 1.45, it's only 6 months. But you're talking about low levered institutional loans there. You're talking about 55% loans. Nobody we're talking to is going to do that. You're going to want between 65 and 80% of value. So you're going to need 12 months. That 100% going to hurt cap rates.
Yep.
Debt uncertainty and spread on treasury yields, 100% going to hurt cap rates. But I do think, because if we come out of this and we start to see more going back to normal, starting to get a little bit more of the rent growth, back to where, even partially where it was, and then there's going to be the demand for all the value add stuff, you can buy a C-class apartment complex for a 5.5 cap, 6 cap, and get the future operating cap rate up into that range you're talking about, which is why C-class apartments are trading for that valuation anyway. So I don't like disagreeing with you because I haven't been through this, but I struggle to see how, if somebody brought me a 9 cap tomorrow, I would beg, borrow, and steal to buy it. So for me to do that, I just think there's going to be, so much demand for, even a 7 cap, I would do anything for, because you can, if you're borrowing at a 4.5, even with extra reserves, and you can add, value on top and get that higher, you're going to cash flow double digits. That's phenomenal. We haven't bought any deal that cash flows double digits, just because of where cap rates have naturally been and where debt has been. So, we would jump all over that, pending deal and location, obviously. So, from that standpoint, unless things get way worse and the unemployment checks, like you're saying, don't come in, and, now collections get significantly worse. I don't know that I see it exactly the same. If we start going into 70% economic occupancy and things get worse, things are going to trade for 7 caps, 8 caps, whatever. Things kind of come through and out the other side, and things aren't too crazy, and, people haven't gotten scared too much. I think we, as a nation, a people, a species, whatever, our short-term memories are so short. All of a sudden, it's just going to be like, maybe it should have been a 6.5 cap, but within a month, it'll be a 6.4. Within 2 months, it'll be 6.3. Within 4 months, it'll be a 6. And then it's just going to keep going down and down and down. And every single deal that gets bought and marketed as a syndication or an investment opportunity is going to be, slashed valuation because of, poor operations, or, taking advantage of, this is the greatest buying opportunity of our lifetimes, and blah, blah, blah. So I just think there's going to be a ton of narrative traps out there. I think there's going to be a ton of things that are going to be sold for things that don't make sense. Because they're just going to be chasing deals.
Let me ask you this question. Because again, we're disagreeing on where this is going to go, which is awesome. If you were to take January and February as a baseline, and you were looking at a deal, how many competitors do you think were looking at the same transaction? Right? Give me. I mean, was it 10? Was it 20? Was it 30? Again, think the peak, right? January, February.
Yeah. Looked at it or offered?
We're just in the mix. Yeah. I think did a level of due diligence.
Did a level. I would say you probably had, depending on how crazy you had to get to make the deal work,
Mhm.
15 to 30 serious groups.
All right, so let's say 30 is a baseline. So let's take that same deal, fast forward to May, right, or
Mm-hmm.
June.
Yeah.
How many people do you think can still look at it, right?
Yeah, definitely not as many. I mean, trying to raise capital now, but that's what we're saying. I think maybe we're talking about different timelines then, because I'm thinking more of like when we get through this and we've hit like that, back to normalization, financials are kind of stable, people aren't really
So
on
you're talking
unemployment anymore.
2022? I mean, what are you talking?
I don't think it'll be that long. I'm thinking
21?
like early 21.
Yeah. Okay. Yeah, I think you got to watch capital. One thing I've learned in '08 in this last crisis, or the crisis we're in now, is you really got to track, lending. And as you just talked about, Fannie Freddie new lending is scarce. Even
Yeah.
institutional money is scarce.
Yeah.
And private money raising capital right now, good luck.
Yep.
I think there's a lot more downside to raising private capital, at least in this small window, like 90-day window, because the headlines aren't going to be good, right? Stocks going to get whacked, earnings are going to get whacked, unemployment in tech is going to go up. We saw the current unemployment is very service-based: hotels, airlines, retail, restaurants. This thing continues much longer. You're going to see tech companies laying off people, or not, or maybe it'll be furlough, right? That's the new word today, right? Furlough.
Yeah. Well, that's, yeah. I mean, everyone's being furloughed now. I mean, it's crazy numbers.
Yeah. So, in the short term, access to private capital is going to be pretty rough. And people have memory there. That they have longer memories for that than others, right? They're going to look at their nest egg and their portfolios down 30%. And, they're going to see, I predict they're going to see some pretty negative headlines with people in your space that didn't run a clean business.
Oh yeah, for sure. And we talked about that last time.
Yeah. It's going to scare people. So these are all things you're going to have to get, get comfortable talking with, but it'll come back. I guess I think it comes back later than you do at this point.
No, I think that's interesting. That's valuable. Yeah, I mean, it's so tough to know. It's crazy to really think about exactly. Sorry, I just got to plug my phone in before it does.
No problem.
Let's hope this actually works. Yeah, I guess it's more of like, I agree. I think it's going to be so driven from the debt side of things. And when does that,
debt.
There we go. And I guess I was looking at it more from like the interest rate side of things and the spread on cap rates and yield and stuff like that. But it'll be, if it's still, if you've got to carry that much of an interest reserve, it's going to be tough.
Think about all that extra money. I mean, you got to get 5 more people to say yes, 6 more people to say yes.
I was talking with, I don't know if you know Antoine Martel, but he's closing on a 24 unit and he was supposed to close end of March. He had to extend because he had an investor back out. He got hit with the 18-month interest reserve because he's closing this month. So he had to raise an extra $100,000. Actually had the seller able to kick it in because he told him, he's like, we're either going to have to extend 6 months or, it is what it is. So he's very lucky in that regard. But yeah, I mean, that's going to crush deals. I mean, that's going to just kill returns.
Yep. Agreed. But that's going to create opportunity. I believe there will be tremendous opportunity, but it probably you won't even see them until September, right? If you don't have to sell in this environment, why would you?
Yeah.
You'd want to have some good news before you start to list, but there'll be some bad operators, some owner occupants, or like mom and pop that need to sell. So it's coming. But it's a lot of newbies think it's tomorrow. Like, oh, I want to buy some deals. I'm ready. I'm like, dude, you're like 4 months early. Relax.
Yeah, no, it's much slower. That's something that took me a while to realize how slow commercial rental takes, like just not even from a movement standpoint, but even just like to implement business plans and stuff, like takes way longer. Whereas like, stock market opportunities were 2 weeks ago, or even today, if you want to say it, whatever, this is going to take, 3, 6, 9 months before you, like you said, deals that go into, foreclosure or any buying opportunities or people in trouble. Cause everyone's got a little bit of reserve. Everyone's got a little lenience, can
Yeah.
extend it a little bit. And then, by the time someone forecloses and then actually brings it to your attention to try to do, a short sale or to get out of it with their skin or whatever. No, it's going
Yeah.
to take some time.
In
So
the
yeah.
commercial market, I actually think I think there will be opportunities in the very near term, if there aren't already, to buy limited partner positions for discounts. Like you might be in for 50 grand, but you need your money for whatever reason. You'll step out for 30 grand. I'm just making up numbers.
Yeah.
But I think those opportunities are probably already there and probably mount over the next 60 days.
Yeah. No, I think there's going to be a ton of people who, a lot of people think like, oh, your deals will kind of get through. But if you've got something else that's hurting and you have to sell something else to support it, like just
Exactly.
because, the multifamily deal might be going well, maybe they own a hotel that's just sunk and it's,
Exactly.
maybe your multifamily deal is 90% collected, but your portfolio is 30% because you own two other hotels.
Exactly.
You're screwed and you can't sell the hotel. That thing's worthless.
Yeah.
So you got to
Well,
sell this and get what you can. So, it's the same thing if, of an LP, is furloughed and, doesn't qualify for unemployment or something else. And, they need the cash. I could definitely see it. I don't know how big it'll get. I feel like at least now it's still early, which is what I always keep trying to remind myself. Like it's still early. It's only
still early. Yeah.
It's still only, call it 3 weeks, really like a solid 3 weeks into this, maybe even less. Even though we kind of looked at it a little bit early and it's been, close to a month that, since you really sat down and looked at it.
Yeah.
It's really only been a solid, strong 2 weeks of where this is hit, maybe 3 weeks. So it's like, it's still a lot of stuff up in the air. Like just because the government says they're going to give everybody $600 a week for the next 4 weeks, unemployment goes to 80%. I don't know where the hell they're getting their money for that. Not that I think that's going to happen. I'm just being extreme, but just because you want a program to work one way doesn't even, mean in reality it's going to work that way. So I keep trying to remind myself that like, hey, take it day by day, take it week by week. Let's get through April. Let's see where we're at. Let's see what's going and, just kind of go from there.
Yeah. What I would tell you is the mindset I have, and I've shared this with everybody that'll listen, is you need to think about surviving through July 31st. That's the mindset between today and July 31st. Mm-hmm. And then it's about thriving from there on out. Right.
Why that date?
Because I'm figuring I'm hoping this health event is behind us in June-ish, right? Late May, June-ish. Then it will take people a while to get back out. Because again, just because you say we're free to go out, I mean, just look at some numbers from China, right?
Yep.
H&M was the best example, which is a company I trust. I do not trust China data, but I trust H&M, which is a European company in China. 89% of their stores are open. Cool. But 79% fall in foot traffic. Right? Back to our earlier conversation, the consumer is scared.
Yeah.
So just because we open the kimono in June, like June 1st, just to pick a date, my guess is it will be until July, maybe even July 4th would be a great day before more people get out and start going to restaurants again. Because I think our behavior will be changed for much of 2020. It's just not going to snap back like that. So that's why I'm thinking July.
Yeah, I do think our country will snap back quicker into going out, just because I get the feeling that the Asia markets have battled this stuff before and they're significantly more cautious about it, just with, face masks being way more popular in a day-to-day before this even hit. It's just just a bigger part of their culture. But yeah, no, I think a ton of people aren't going to step right out day one and go back to doing stuff. And that's another struggle for me, because I'm like, as soon as the bars are open, I'm going to be out there and going. Just because I'm like, oh, it's going to be great to see people for like a few days, and then I'm going to be like, I hate people and I need to get back inside. But no, I agree. I think it's, it's going to take a while to bounce back and really people to feel comfortable. I think it's also largely going to depend on like how many people do get infected and when does the vaccine become available and stuff like that. So I think it's
again, if you can survive, I think if you survive through into July, you survive the worst of it. And in July, so I picked July because it's far away.
Mhm.
right? I certainly, if we're still on lockdown come July 31st, all bets are off. Forget it. That's crazy talk. But yeah, I think it's survive. It's, delay capital expenses. It's, be in communication with your tenants. Make sure your tenants who aren't paying are getting unemployment. It's a little more heavy lifting, but if you can survive this part, the
Mhm.
rest of your investing career is going to be easy, because just like I can look back at '08 and go, wow, that sucked, but we made lots of money. You're going to be able to say, wow, we survived a cataclysmic event and we came out stronger. So that's what I would tell you to focus on. And you're doing the right things. You just, you're in the first inning.
Yeah.
You're not in the fourth inning.
Nope.
It's probably the bottom of the first, right? So
No, it's definitely early. Awesome. I think that's a great place to wrap up. I don't want to take up forever. Thank you so much for doing this. Obviously, anybody who is following me on IG Live can tap the little bubble at the top and follow Michael. But for the Zoom call, can you tell people where they can follow you? And for anybody else, is there any other places they should check you out, get in touch with you, stuff like that?
appreciate it, Chris. Again, Michael Zuber. Everything I do is one rental at a time. Best way to follow me is on YouTube. I produce 1 or 2 original videos every single day, 7 days a week, 365 days a year. So check me out there. Hit the subscribe button. That would be great. And if you don't like watching video, all my weekly content gets converted to a podcast format. Again, one rental at a time. That happens every Saturday.
Love it. Guys, definitely you should go check it out. I'm a big fan. I love watching his stuff. Too much for me to always keep on top of, but at least once a week, every other week, I like to pop in and see what he's doing. Can you just leave us with final thought, words of wisdom, something like that, just to end us off?
Yeah. So what I would tell you is this is not 2008 again. This will be short. This will be brief. It will be painful.
Mm-hmm.
But as long as you don't do anything silly or stupid, you will get through this. In 10 years from now, you'll be telling people how you survived this. And I'm excited by what's coming. I actually believe last week was the worst of the bad news. So going forward, the good news can start to dominate. So I'm pretty excited about what's coming.
Love it. Brilliant. Thank you so much for doing this, guys. Thank you so much for tuning in and watching. We will have it up on YouTube soon. Everyone have a good night.